if you buy traditional whole life insurance, it's expensive. And that's what I ended up doing. I bought a traditional policy. And I even asked the guy, I said, hey, is there ways we can pull different levers and make this more cash rich? Because unlike insurance, where it's always death benefit focused, whole life insurance also has this tax-free savings account called cash value inside of it. This is like
Hmm.
a high yield tax-free savings account. Right now, by the way, it's paying like 6% a year tax-free, right? With no
Awesome.
risk, no market risk, none of that stuff.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Hey, today I get to sit down with the anti-financial advisor and founder of Money Ripples. His name is Chris Miles, and he's got a company that's helped over 1,000 entrepreneurs and professionals create real passive income and become financially free years, even decades ahead of schedule. Chris doesn't just talk about financial freedom, he teaches people how to build it right now through strategic cash flow, alternative investments, and financial efficiency. And if you've ever felt like traditional finance keeps you trapped on the treadmill, this episode is your blueprint for escaping it. Some of the things I really enjoyed talking to Chris about is going through his story of, even his father who did everything right that the system told him to. Well, Chris was a financial advisor helping his father. And just the lessons that were unpacked along the way. Chris also talks about some of the things that you can think about as you move from going from the traditional finance, the working with financial advisors, even if you've heard of financial advisors that are fiduciaries, and the things that you should be doing instead. We talk about alternative investments, and as well as something he drops at the very end that you should definitely check out if you're looking to take your investing game to the next level. So there's something for everyone here. Now, Chris has something called, I think it's called here, the work optional blueprint. Make your money work so that you don't have to. This is something that, takes those milestones along the way wherever you are and helps you get to that next one. Something you should definitely check out. Check out his podcast as well. And just kind of listen here, tune in. And if you think you know something, this is one of those ones where you definitely want to listen to again to fill in any of those gaps they might have, because that's really where there's mastery. Chris likes to say here, and quoting Tony Robbins of success leaves clues, and you'll definitely get to hear some of those nuggets in this one. So sit back, please make sure you take notes, and as always, please enjoy. Mr. Chris Miles, thank you so much for being on the show. Now, you like to call yourself the cash flow expert, but the anti-financial advisor. And I've got to say, that was really cool to see, because checking you out, learning more about you, and hearing about the partnerships that you're in with Garrett Gunderson and the whole experience that you've had as well has been really cool. And I think you're a perfect guest for the show for many reasons that we're going to get into, but I think is super relatable for many of the listeners too here. So would you please just quickly introduce yourself? And then I've got some questions for you to dive in.
Yeah. I mean, as you mentioned, the anti-financial advisor, right? I mean, I actually used to be one. That's how it started in my journey in the early 2000s. I did that for 4 years. I drank the Kool-Aid. I mean, much like probably what a lot of you guys as listeners have been doing too, where you've been, strict savers, you've been budgeting, you've been saving, you're doing everything you're supposed to do. You even make sure you're studying the right, ETFs or whatever you might be doing right. I was even a stock trader as well and teach people how to trade stocks and options. And I was drinking the Kool-Aid. And I
Mm-hmm.
believe that if I kept doing that for the next 40 years, I was going to be financially free. However, 4 years in, I'm sitting down with my dad, and he was the kind of same kind of guy, penny pinching saver. The guy was like post depression era mentality. He bought everything on sale. Everything we ate as children was basically bought on sale. I ate Cap and Crunch for an entire year straight. I still have scars on the roof of my mouth from sucking on those
Oh
things,
yeah.
right? Like just that kind of guy. And so he even said, he's like, Chris, I'm 61 years old. I want to retire at some point. What do I need to do? And I thought, okay, he's going to be there. I'm going to show him how to hit retirement. Well, I look at everything. He had paid off all of his debt, including his house, 100% debt free, stuffed money in his 401k, getting the company match like every good boy should.
Mm-hmm.
And yet I said, Dad, if you try to retire today, you're going to have to die in about 5 or 6 years because that's when you'll run out of money, even based on your somewhat tight budget. He said, well, that's not what I wanted to hear. And it didn't help that Y2K had happened. It was recovering from that. He didn't even realize it was a couple of years before the Great Recession was about to hit, and that was going to affect his retirement accounts even longer. And so my advice to him was, when he's like, well, what do I do? I'm like, work longer,
Mhm.
save more, which is what every financial advisor says, right? There's
Yeah.
never an end point. And he did. He worked until the mid 2010s, till the market finally came back to where it was in 2000, and then was finally able to retire, but on a very strict budget.
Yep.
And that bothered me. It bothered me a lot. And I remember it was just a month later, I was talking with a friend of mine. I had trained him to be a financial advisor, but then he left to go do real estate investing, like we talk about on the show, right?
Hmm.
And he's talking about he's doing a lot of flips and stuff. And he's telling me like real estate's better than stocks. And I'm arguing with him like, no, stocks are better. It's proven. I got the charts to show you. The
Yep.
Ibsen chart will show you since 2000 BC, stock market, small stocks beat real estate every time.
Right.
And he finally just stopped me. He's like, well, Chris, how many of your clients are actually really financially free where they don't worry about money?
Hmm.
Well, none of them. They all worry about money. Even the ones that are retired still worry about running out of money too soon. Okay, great. Good job. How about this? How many of you guys as financial advisors are financially free, not off the commissions you've been earning, but actually doing these same investments you've been recommending? And when I realized there was guys in my office working since the 1970s that have not been able to retire yet, I thought maybe he might be asking a good question.
Yeah. Yeah.
And so at that point, I said, all right, well, tell me tell me what would be the answer then? He's like, I'm not going to tell you. You just got to argue with me that stocks are better. I'm like, listen, you got me to admit that there's a weakness here. Give it to me. And so he had me read a book, Who Took My Money, which is a lesser known Rich Dad book
Hmm.
by Robert Kiyosaki. And then he had me listen to this AM talk radio show, pre-podcast era. And after listening to these real estate investors talk and stuff for several months, I realized I had a choice. Either I keep teaching what I'm teaching as a financial advisor, or I quit. And so I
Yep.
chose the latter. I quit. I said, I'll be a mortgage broker because 2006, anybody could be.
Hmm.
And I'll teach ballroom dancing on the side. And that's what I was doing. And long story short, later that next year, I wanted to learn what these guys knew. Even though I didn't do so much with the flipping, although I did flip my starter home to an investor, cashed it back, all that equity out, and
Yep.
then went and leased it back from him again, so I could sublease it to an investor or to a renter, right? So I was like, now I'll equity strip everything, and then I'll go still rent my old property, and then go buy another one. And
Hmm.
and so I was doing that, but pretty soon, with just realizing I can actually lend my money to investors and do different stuff, I was able to retire at 28 years old. Granted, I only needed 3,500 a month to live back then in 2006, but it was, still, I was like, dang, this is something I never expected. I
Yeah,
thought
for sure.
hopefully by my 40s or 50s, I might hit it if I just scrimp and save every dollar I've got. And that's when I came out of retirement in 2007. That's when I partnered up. You mentioned Garrett Gunderson. We created a company together called Freedom Fast Track that later became Wealth Factory.
Oh, cool.
Um, and during that time, 2007, we opened our doors. We're like, here you go. We're going to save the world, show you how to create passive income. Not that there was a process to show them how to do it, but we would talk about it. and next thing you know, the recession hits. All the people we were talking to were real estate flippers. They went broke. So our company was about to go broke and go under. At the same time, my real estate wasn't doing great. And I was in the hole over $1 million in debt by 2008.
Hmm.
And I had to figure out how to dig out of that hole without filing for bankruptcy. I avoided bankruptcy, but it was painful.
Yeah.
Finally, in 2009, I started to teach different things. I started teaching people how to find and free up cash, which you hear guys like Wealth Factory talk about nowadays. That's all my old stuff that they're teaching. I started to do that kind of stuff. Instead of trying to teach them how to get out of rat race, how do you find money so then you have money to do stuff with?
Sure.
And so I started to do that. And then the next thing you know, we pulled our company out of near bankruptcy. We started to take off that next year. And that also started helping me personally too, to start paying off a lot of those debts and getting myself to a place where not only can I pay off the debts, but then have some cash to then invest again.
Of course.
This time, much smarter this time around, and going in real estate, where I went more hands off, more passive investments, like you guys probably talk about a lot on this show.
Hmm.
And then, of course, from there, by the end of 2016, I was able to do it the second time. So I was 39 years old, second time I did it. So people might think like, wow, you retired twice by 39. That's so cool. No, I just screwed up the first time, right? I was an idiot the first time because I was overly ambitious, thought I had the Midas touch, and
Sure.
that ego got me, and so that's kind of my basic story. And that's what I teach people now, is how to become work optional. The Work Optional Blueprint book just came out,
Yeah.
where I teach people how to create enough passive income to work because you want to, not because you have to.
Yeah, I mean, talk about a gut-wrenching conversation with your dad too, right? Like,
Yeah.
especially having, like, grown up in that environment and, there's a lot of values. I know value-based investing, not like, like the personal values, not value about the stock or value about investing, but, the personal values you got probably were really ingrained in you along the way too, and just,
Mhm.
seeing your dad having, quote, unquote, "done everything right" as far as the system says to do, right?
Yeah.
And seeing that that's not exactly the way. And,
Yeah.
I have some questions, but I just wanna put an insight for awareness too for anyone listening. It's just like, you know, I constantly look at, okay, is the path I'm on, do I want to be like those people 2 or 3 or 5 or 10 years, ahead of me in this route? And that
Mhm.
is always just something to look around to, right? So, you know, you talk about being a stock investor, and you've obviously gone through the fire and many, many just rounds of learning over time here. But I think one of the things that people still aren't quite sure of, I'd love for you to shed some light on is, you know, what are stock brokers, not bad people. I'm sure they want to serve other people too. Everyone needs to make to put food on their own table. But what are just some of the things that you learned about that they're able to do or not do to really serve their clients at the fullest level?
The biggest thing is understand that when someone's a like a financial advisor, right? Or they're securities licensed, they're not licensed to make you money. They're licensed to sell you a very niche suite of products.
Hmm.
In fact, literally, as a financial advisor, they're always talking about different products, right? From
Right.
different companies. It's all product based. It's really a sales job. You're really a salesman in a suit.
Hmm.
So, like for example, up until 2005, I was licensed to sell people, mutual funds and annuities and variable annuities and all this kind of things, the traditional stuff you would see. But if I wanted to go do something outside of that, they call it an OBA or outside business activity. The thing is, my license, I'd have to ask for permission. And they would often restrict me from doing things that might even make sense. Main Street investing, it could be investing in a business, it could literally be investing in a syndication. They would
Hmm.
say, no, you can't. Right. And of course, when it comes to working with your clients, your advice is the same. It's literally like to a hammer, everything is a nail. It has to be mutual fund or insurance based, right? I was also had an insurance license, still do actually to this day.
Cool.
And so it's a very insurance based, right? And that's the thing that most people don't realize that you're not someone who's going to help people become wealthy. You're somebody who just says, "Hey, you want to be able to check this box for these orders? Here, I'm going to try to fit you into my little, square peg, or your square peg is going to have to fit into my round hole of products. But if you ask me, hey, should I put money in real estate? I'm going to be skewed and say, that's risky. I don't know if I would do that. I had a brother-in-law who his father literally became a millionaire at age 21 in the 1960s after being homeless at 16. So
Mm.
homeless at 16, 5 years later, his dad became a millionaire. And I remember that brother-in-law asked me, he said, well, Chris, I can give you 10 grand to play with today. And you're saying maybe I can make 12% a year? Because I actually believed 12% was real.
Mm.
That was BS. I said, yeah. He's like, well, okay, well, Chris, that 10 grand will make me 1200 a year. But I could take that same 10 grand, I could put a down payment on a semi truck because he had some, like dealerships,
Hmm.
right? He's like, I put a 10 grand down on a semi truck, turn around and make a 20 grand profit in a couple months. So why would I, 10 grand in a couple months versus maybe 1200 a year with you? Why would I put my money with you? Well, you should be diversified. You should put all your eggs in that one basket. Besides, business is risky. Ironically, I had a business as a financial advisor, right?
Yeah.
That's the problem. So you got to be careful that it's not that they're bad people. I cared very deeply for my clients, but I was drinking the Kool Aid because I was being brainwashed by the people that employed me, which are the financial firms. Yes, I work for my clients as a fiduciary, but it's the financial firms that give you all the education. They're the ones that pay for all the ads that you watch when you go watch financial media.
Yeah.
They're the ones that are literally teaching everybody what to do. It's the banks and the financial institutions that are giving the education, not to serve the client, but to ultimately help them make more money.
Yeah, Wall Street. Talk to me about, you mentioned fiduciary. Some people may not be familiar with this. I'd love for you to talk about what that is too. And, this was a super popular term,
Mhm.
I don't know. It must have been what going on 9, 10 years ago. Maybe it was before that too. Maybe that's when my sphere of awareness really started to hit a little bit. But what does that mean?
Yeah, it's an interesting term because it makes people feel warm and fuzzy. It's
Yeah,
kind of like, the
exactly.
movie Tommy Boy. It's like you put a guarantee on a box, but you get a guaranteed piece of crap.
Yeah.
It's kind of like that too, because a fiduciary just says that you have the client's best interest at heart.
Hmm.
That's really what it comes down to. Now, even if you don't have a securities license, that's even true with my insurance licenses. Whenever I renew them, take my continuing education every 2 years, like I've done for the last 24 years,
Hmm.
same thing, right? It's like you're always trying to show how, and illustrate, here's how you do the right thing for the client, the right product fit, as they would say, right? Like, how do you
Right.
match them up with the right thing based on their goals, their risk tolerance? You'll hear stuff, right? So you'll make them take a little risk questionnaire and they'll say, oh, well, you're moderately aggressive. Therefore, here's your little served up on a platter, moderately aggressive fund you should put your money into. You don't know what's invested in, but have fun, like
Yeah.
there, my hands are clean. I'm
Yeah.
good. So it's kind of a deceptive term because fiduciary does not mean you don't lose money. In fact, you could lose a lot of money, and I would still be a perfect fiduciary for you.
Crazy.
Because if it's the market, it's not my fault, right? I'm just the blind leading the blind. I always refer to Robin Hood Men in Tights. Where the blind guy Blinken's up on a watchtower saying, I'm guessing no one's coming," and that's what you do when you're a financial advisor. You don't know what's going to happen in the market. You don't know what's going to happen to your money. You're literally just your advice is going to be, you know what? Just keep buying. Dollar cost average.
Right.
Just keep plugging along because nobody knows if it's going to go up or down. Your best thing. In fact, if the market goes up, don't stop buying. But if it goes down, it's on sale, so buy more, right? Which is such BS because if you think about that, it's literally saying if it goes up, that's the opposite of dollar cost averaging. It's like if it's going up, being more expensive, stop buying. Wait
Right.
till it crashes, then buy a bunch. But again, they just say, well, you never know, so just keep buying along the way. What a perfect marketing strategy for a financial institution in Wall Street to tell you, right?
Always keep
There's
buying.
never a bad time to buy. It's
Yeah.
always a good time to buy. That's the deception, right? And so you could be a fiduciary, teach them this kind of stuff, teach them that really, you tell them 12% average, but in the reality, the actual returns of the S&P for the last 30 years is average 8.5%,
Hmm.
not 12. And so you start teaching this kind of stuff and you realize, wait a minute, I'm a liar. And that's kind of what I realized. That's why I had to leave is like, wait a minute, I'm teaching all this stuff and it's a lot of half truths, right? It's like, how do I skew it? And that's really, that's what they're teaching me. They teach me skewed information and then I pass along to the client. And so be careful. Fiduciary does not mean that your money is safe.
Got it. So, it begs the question, right? I mean, a couple key points before I ask the question. Then it's like, okay, if you go to your financial advisor, like you were saying, even in the story, the conversation with the friend is just like, how many financial advisors are making financially free from their own skills, applying what they are doing, not just from the
Mhm.
fees, fee driven, coin operated, right? And
Yep.
so that's one part to it. But then, like you were talking about, we're looking at, okay, financial advisors, people that are trying to make the right decision with their money. And if I
Mhm.
can, make this even a smaller target of, well, I should go to a fiduciary who is supposed to have my best interest for me. And I'm, again, not saying they're bad people. It's just,
Yeah.
this is something that is in the industry. It's like, okay, but if not them as well, then what are the things that I should be doing, Chris? Like, I'm the listener here. What are the next steps for me? Like, where do I go for this? Do I go read a book, and then if I have to trust who, what they're saying? I mean, whoever is learning has to trust what we're talking about right now too. But
Yep.
so, what has your experience taught you here?
Success leaves clues. This is something that Tony Robbins says a lot,
100%.
right? And that's something my dad even taught me. He said he's like listen, don't like education's fine, and he wanted me to get educated. He wanted me to get my college degree and get the good job, right?
Hmm.
But he also taught me he's like, well, look for real evidence, right? Look for something that's real. Well, when I looked at the lives of financial advisors who are even practicing what they preach, looking at the lives of their clients, like it's pretty evident. I mean, it's just like Fidelity. Fidelity comes out with their statistics. They just updated their numbers. They have about 45 million clients in America. That's a
Mm,
lot.
that is.
1.1 million of those accounts that they have at least $1 million. That's roughly a little over 2% of all their clients have at least $1 million. Yet in the traditional financial world, if you're in your 60s, especially let's say that you're 62 years old, you're only supposed to pull out 3% a year, not 4%. That rule was debunked a long time ago.
Mm.
3% a year. That's 30,000 a year,
Yeah, it's
which is
nothing.
why you look at another study. Transamerica did a study at the end of 2023 saying they interviewed these same people that had $1 million or more in their accounts, and 35% of them, I bet you a lot of them are in IT, by the way, 35% of them said they would take a miracle to be able to retire.
Hmm.
Why? Because if you're trying to live on 3% of $1 million at 30,000 a year, you have to have at minimum, if you want to have a decent lifestyle, $3 million saved up. And that's a much smaller percentage. And I talked about this on my Money Ripples podcast recently, that there's a difference between failure and risk, right? Risk is chance of loss. And here's the thing, like you asked about what's the answer. Like I like to look at alternatives, Main Street investing, things like real estate. Here's the deal though. Are there situations in real estate where you could have 100% risk, like in the sense you could lose everything? And the answer is yes.
Hmm.
What's the likelihood that you're going to have a risk to lose everything in the stock market? At least with mutual funds, practically zero, right? I wouldn't say it's impossible, but it's very, very improbable. So there's lower risk to be in mutual funds than there is to be in the stuff that I talk about, which is like real estate investing and oil and gas and businesses and things like that. However, the failure rate, when you look at the failure rate of what's the odds of success with mutual funds, it's nearly 100% failure rate. Because
Mm.
like I said, you have to pretty much be in the top 1% to even make it work, right? And this is why I get mad at the whole FIRE movement,
Mm.
financially independent, retire early. Funny enough, as you know from my story, I was fired twice, right? I was financially independent before the age of 40 twice.
Yeah.
I got in that Facebook group, they kicked me out.
Mm.
And they kicked me out because I said, "Hey, you guys, you realize that the way the numbers work, because I thought they were just like me. I thought they were investing in real estate and doing stuff. No, they were purely relying on like the S&P 500 index,
Oh, I didn't know that.
And I said, well, guys, if you're doing that for you, if you're under the age of 40, it's a 2% rule, not 4, it's 2%. You got to save double.
Yeah.
And they got mad and kicked me out because they're like,
That's
no, 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 don't mess with that. Because I like to live and minimize my life as much as possible. Don't even get married. Don't have kids, because then I can live on $3,000 a month. And then if I do the 4% rule, right, then as long as I have about $700,000, I'm good. It's like, no, if you want to be in that place, 2%, you got to better have a couple $1 million saved up, to live on that.
Yeah. Plus, things
So
keep on going up as costs, and I mean,
exactly.
like, yeah, there's so many wrong things wrong with that argument.
Well, and that's why the 4% rule got debunked, because it was the guy who created it in the 90s. He was based on 1925 to 1975 approximately, right? So he was looking at that 50-year time period of the stock market. But remember, 1974 was when Nixon took us off the gold standard.
Yeah, yeah,
Inflation increased
yeah.
significantly since that time period. So inflation's higher, life expectancy is also higher than it was in 1975, right?
Yep.
So like you said, people are living longer. Inflation's worse. That's why even in your 60s, it's 3%. It's only a 4% rule if you're the age 70 and above. That's where it hits 4%, which is why you hear money managers talking about, hey, work till you're 70. That's the new retirement age now. Like,
Yeah.
I heard that from I can't remember who it was now. I think it was Diamond. Oh yeah, Jamie
Mm.
Dimon, who actually said that. And it's like, man, see, this is the deception that we're all taught the same old thing of you could retire at 60 or 65, or it's just not reality.
Yeah. So I'd mentioned this when you're, I mean, there's a lot to unpack here. There's a lot of really
Yeah.
cool things to go deep on here, but I do want to ask some questions to get some targeted value out of this, because I think
Mhm.
you're bringing up some really great points. And one of those of which is basically, the tradition, the system, the traditional system is there. It's like, it's not quite the answer.
Mhm.
Whatever it's your 401k, 59, I don't know. Is it 59 and a half still? Honestly, I haven't
Mhm.
even paid attention or
Yeah.
if it is or not. But that's one thing of like uh if people are putting money into that, sure. But the other thing is, okay, if not the stock market, what else? Real estate and alts and stuff like that.
Mhm.
Really, what this comes down to is kind of taking ownership and getting educated, right?
Mhm.
People go to financial advisors to be like, well, hopefully they know more than I do about this, right? But would you say that it's really about education is where it's at?
100%. I mean, that's why I had to write my book. I mean, even though I absolutely hate writing, that's why I've had my podcast for 11 and a half years for that same reason, because really you have to undo the education, really the brainwashing, right? It's almost become dogma. It's not even rhetoric. It's like dogma. It's like a
Absolutely.
religion almost when it comes to financial advisors and what they teach. You mentioned 59 and a half. A lot of people don't realize that they can change the rules on that 401k anytime. What if you're like people in France who thought they're going to retire at 62 when they bumped it up to 65? And you're like,
Mm,
wait, I was going to retire next year. Now I got to wait 3 more years. Come on,
yeah.
that kind of stuff happens, and that can happen in the US too. And so that's where this comes into play, right? Like this is when I shifted my perspective, because you do need education. And again, learn from people that have actually been there, done that, and they're still doing it today.
Yeah.
That's people I look for. Like success leaves clues, as I mentioned. So like when I first learned about this, I realized it wasn't about accumulating a lot of money. Like before we went on the air, we talked about net worth, right?
Yeah.
Net worth is so deceptive because if it really were the key to financial freedom, why do I have so many people worth 2, 3+ million saying, I need help? I had a guy literally 59 and a half years old say, hey, I've got $3 million net worth, but only $300 a month of actual passive income coming in. I can't stop working. My
Crazy.
Vanguard guy, he won't give me an answer. He won't tell me how long I have to keep doing this for. I said, well, that's because the Vanguard guy is scared because you got $2.1 million in your retirement accounts. Although you can access them, you want to live on 200,000 a year. To live on 200,000 a year, you got to save up to $7 million. Even if the guy spent the time to even tell you that number, do you think he's going to want to tell you got to about triple your retirement account? He's
Yeah.
like, no. He's like, that means I'll have to work till I'm 70. He's like, I don't mind work till I'm 70, but I at least want the option to not have to work till I'm 70.
Yeah.
And I and that's where I told him, it's like, this is the difference between the accumulation theory that every financial advisor teaches and cash flow, right?
Yes.
Having actual income. Income is where freedom is, not net worth. Net worth is worthless unless it's paying you income, stable, predictable income.
Dude,
And so
expand
I
on
gave him an
this.
example.
That idea of when I first heard that you can't eat net worth, this is what we were talking about, you're
Uh-huh.
referencing, was just like a, "Oh my god," you know? And
Yeah.
so keep going on that.
Well, it's kind of like my dad. Like I did one thing I don't often say in that conversation with my dad, that when I had to break the news to him, when he was asked for solutions, I said, well, you got your paid off house. He's like, well, then what do I do? I'm like, well, you can do a cash out refinance. You can invest it. But I knew I couldn't put it into a mutual fund because it's illegal to do that, to borrow money and put into a mutual fund. You can do it
Mm,
with stocks, just not with mutual funds.
okay.
And so I was like, well, I can't tell him to do that. I was like, I can put it into annuity, but I can't guarantee that's going to make enough money to offset the interest. Right. And
Right.
I was like, sorry, I don't know what to do. That's the kind of thing. That's why reverse mortgages can be kind of a cool solution for him, right? Which
Yeah.
he actually, by the way, just did to help him stretch out his dollars. But that's where I realized, like, it is about income. Income is everything. That's what really people are looking for.
Yeah.
And so that guy, he's like, hey, you got 2.1 million in your retirement accounts. I said, here's the deal. If you put your money in some of these alternative investments, like for example, you could lend your money to real estate investors where they contractually have to pay you a return. Say it's 10% a year. Well, guess what? 10% on 2.1 million is how much?
200,000.
210,000 a year,
Yep.
right? Where right now, if you try to do that 2.1 million, live on 3%, yeah, he'd live on 63,000 a year, but he wanted 200,000 a year. He didn't
Yeah.
want that, right? And that's the difference. I said, honestly, you don't have to work till you're 70. You could probably do it this year. I had another client who was 60 years old. He actually just passed away this last spring. He was 64 when he passed away, but when he was 60, heard me on a podcast show like yours,
Mhm.
actually, the guy, by the way, was in IT, funny enough. Then he followed me on my podcast, and then he reached out. He said, hey, I just retired, and I have $1 million in my account, but the financial advisor told me I can only pull out 30,000 a year. And I said, well, at least the financial advisor was honest,
Yeah.
because some won't say that. He said, yeah, he did. I can't do that. I live in California. No one can live on 30,000 a year. You're homeless at 30,000 a year.
Totally.
And so I said, all right, well, let's see. And so we help them diversify, right? Because we're not investment advisors, but we do help people one-on-one strategize and do things like that. And so we said, hey, if you do this, like, look at diversifying. Like, you could go buy a few duplexes that somebody else manages, like turnkey rentals, for
Mhm.
example, right? You could do some apartment syndications. You could do some things with oil and gas.
Mhm.
And instead of 30,000 a year, that million now became over 130,000 a year for him.
Awesome.
you know, Drastic difference. And the great thing is, like I said, he passed away this last spring, which was really a shocker to me. He just died of a heart attack on a Monday night working at his desk. But the thing that made me grateful is at least he had those 4 years, right?
Mhm.
That he was able to live life on his terms. And I think that's the thing that most of us don't realize, that sometimes we think we'll live forever, but we don't know, right? We don't really know. And all we have is right now. That's why my sign says, live your life now, not tomorrow, because truth is that You could be working and slaving away for decades trying to save in your cruddy little 401ks, and you'll have all the logical reasons about why they tell you it's so smart and buy those S&P 500 ETFs, right? And go ahead and buy those, and because they're low cost, and you'll just make it. But unfortunately, if you're under the age of 40, you've never seen a bear market. You've never seen what happens when the market shifts and turns around on you. And by the way, the next 10 years, I think are going to be kind of ugly in comparison to the last 15 or
Yeah.
now going on almost 17 years of a straight up bull market.
Yeah.
So that's the kind of thing you got to be aware of. So that's why, again, you go for income, not trying to, get this account balance to go higher, because it doesn't mean jack squat until it actually produces income for you.
Yeah, dude. For sure. So I'm kind of curious, and I'll let you kind of I'll put some things on the table here, and you can kind of take us where you want to with this part. But one of the questions that comes to mind here is, people have been putting money in their 401ks as an example.
Yeah.
Maybe people have, it's a totally separate conversation, and people have been through multiple employers, and they have 401ks that are still out there. They could roll into an SDIRA, right? That's
Yeah.
self-directed. But the other is, let's say they're still um uh let's say they're still at their employer, and they've been putting into that, they're still employed for a while they continue to invest in these other things. What's kind of the strategy for that person in that role right now?
First is I got to blow up the 401k because, I mean, as much as it seems like it's brainless, unfortunately, that's what's happened is people have turned off their brains with the 401k.
Hmm.
People always make the argument. They're like, Chris, well, I'm not putting all my money in the 401k, although a lot of people do max fund it.
Yeah.
They're like, no, I just do up to the match. I get 100% return. You get 100% return one time, but it's not compounding 100%. Trust me, if you put in, say you're putting in 10,000 a year into your 401k, put this in the calculator, the compounding interest calculator online right now,
Hmm.
10,000 a year, and say 108%. Let's say you get 100% with the match and 8% in the market, and find out that you'll be richer than Bezos and Elon Musk in just about 20 years. That said, nobody ever in a 401k, right? Like, it's just not the case. Unfortunately, that 100% match only adds about a 3% return long term when you look at a compounded interest. But the sad thing is, like Fidelity, going back to them and their actual statistics, I looked at their target date retirement funds, which is what
Right.
86% of millennials are picking right now.
Yeah.
They underperform the stock market without fees, right? Just from the market itself, 2.1%. You add in the 0.75% minimum fee that
Yeah.
they
Okay.
have on there, it makes about a 3% loss, right? So ironically, the match gives you that 3% gain, but the underperformance and the
Wipes it
fees and
out.
the 401k offsets it. And so you'd be just as good going into that spider fund, right? That's a big
Okay.
issue.
So based on that, should they not even go for the match?
I wouldn't even go for the 401k at all, personally. I mean, now there could be a use for it. If you're saying, I don't care about retiring till I'm 65, 70 years old, even if they raise the age on me, fine, I don't care. Cool. There could be a use for that. You mentioned self directed IRAs. If they already have one,
Yeah.
like I have a 401k or an old one or an old IRA, cool. Self directed, there's some cool things you can do with that right now,
Yeah.
and then figure out if you want to dismantle it later. But if you have the choice, and trust me, I do, right? I can set up my own 401k, and I don't, because one, I don't trust the government because I know how they like to change rules, and it usually favors them, not me.
Yeah. Of
Um,
course.
but secondly, I don't want to wait till I'm 59 and a half or whatever age they pick for me.
Right.
And by the way, I didn't, obviously. And so I tell people these three things is get lean, get liquid, and get out. And
Okay.
get lean just means be a wise steward of your money. Make sure you watch your spending. Don't live on rice and beans. Don't have to cut out that latte like David Bach and David Ramsey and all those guys say, right? You don't have to do that stuff. It's just be a responsible steward of your money. Don't blow it all. Secondly, is get liquid. That means don't lock your money up in prison like the 401k or extra trying to pay off your house early. I
Hmm.
had a guy that was in California that was trying to do that, like very methodical. He was like, I'm going to be able to pay this off in 6 years. And then when I do that, then I'll between my house and my rental property, I'll free up $4,200 a month. I
Yep.
said, okay, that's cool. But look at this rental property. You got 800 grand of equity. What if you sold that and actually put it into something that gave you better cash flow? Because his cash flow is $200 a month.
Yeah. It's nothing.
And his return on equity is horrible. He could have cashed that property out, put in a CD, and made more money.
Hmm.
So I said, instead, why don't we go and buy properties like out more in the southeast? So
Hmm.
he did. He bought like 6 properties in Louisiana, cash
Turnkey.
flowing him over 6,000 a month. He's now
Wow.
reinvested that cash flow to where last year he emailed me. This is only after like 4 years or so. he emailed me, says, "Hey, guess what? My cash flow is over 8,000 a month."
Awesome.
Just from that one property was $200 a month, right? So he had his money locked in my prison because he was so, I mean, he's like most of my clients. I have a lot of like Asian clients and they're like the best super savers in the planet, right? And and he was no exception. And he was like, "No, I just got to pay off this debt. And when I do that, then I'll keep putting money in my retirement account and then I'll be good." He's in his 40s. And now he's like, "Now I see it." It took him 2 years, by the way, to actually sell off that property. He overanalyzed himself to death on this,
Got to
right?
chip away at him, man.
Oh man, I gave up. I mean, finally, he just convinced himself, because he's like, California may not go up forever. Man, I should sell my property now, and
Yeah.
so he did, and it paid off for him big time. And that's the point, like it's really about moving your money out of prison. That's where the get out comes in. Is get your money liquid. Don't trap it in home equity. Don't trap it in 401ks where you can't touch it, right?
Mhm.
Unless you get laid off or you quit. Don't
Yep.
do that. Get in your control and then get it out to things that actually produce income right now. And
Yeah.
this is essential because, especially, I mean, I'm seeing it left and right. I'm sure you are too. I have a lot of clients in the tech space right now, and they're watching their. I mean, not even because of AI. Even before AI was starting to take things over, right?
Yep.
There was people that were losing like good high level middle management positions because they're
Mhm.
trying to streamline their companies and whatnot. And that's scary. I've had some people that literally been out of work for the last year.
Mhm.
Luckily, when we tell them keep at least 12 months reserve, especially if you're in the tech space,
Yep.
of just cash, but then also diversify your income. Because I
Oh.
mean, I had one client that was he was also in California, but he was in Hollywood, and 2020, you remember that year, right? Like half
Mhm.
the year they were shut down. 2023, they had the writer's strike. So
Mhm.
about half of that year they're shut down. And fortunately for him, he had about, 3,500, 4,000 a month coming in from passive investments
Nice.
that was able to keep his savings lasting a lot longer. So he didn't have
Yep.
to rush to the next crappy job. He was able to be a little bit more selective and pick the right ones.
Yeah,
And
multiple
that's
streams of
no
income
different
is
for us.
key for sure. So you had maybe I lost track of there. So lean was the first one, liquid was
Yeah,
the
get
second
lean,
one,
get liquid, get out.
get out. Okay. Uh get out, get out of your
That's get
the
out to passive investments and stuff. So
got it.
when you get that money in your power and your control, you get it liquid,
Yep.
then you get it out to things that pay you income.
Okay, invest it in stuff. Get out there to invest
That's
it.
right.
Okay, cool.
Yeah.
Talk about some of those things because, most we talked about really traditional things, right?
Mhm.
Right, and you mentioned some of the other things, real estate investing. Obviously, you mentioned oil and gas. You mentioned
Yeah.
syndications. I look at funds as well, like private credit and etc. Um, private equity being another one, but
Yeah.
I'm sure. Talk about what some of those some of those other investment types are.
Yeah. So I like personally, I mean, there's all kinds of things. Anything that's Main Street, business, real estate, oil and gas, gold, commodities, things like that, silver, of course, even digital currencies is an alternative investment, right?
Mhm.
We hear people talk about crypto all the time. I mean, these are all alternatives that are outside Wall Street. And that's what we more talk about and focus on. So give you an example, like, I mentioned like turnkey rentals. Like if you're like me on the western half of the United States, rentals out here are a joke, right? I mean, you're in Austin, you even know. I mean, it's horrible.
Yeah.
It's a horrible market to buy rentals in. But if I go out in the southeast or the Midwest, I'll find properties for like $200,000,
Yep.
300. I actually had somebody tell me they're like, "Yeah, I just got an offer for a $300,000 duplex in good condition,"
Nice.
right? And the rent, total rent on that is 3,600 a month. That's
That
incredible.
is incredible.
You don't find those deals very often. I told him, like, dude, if you got that, you might want to get liquid and get that money out there.
Yeah.
So those kind of things. But again, I don't like to be the hands-on investor. I'm not the person to be wholesaling and flipping and doing that kind of
Same.
stuff. I did it and I hated it. I like to be hands off where I actually have some freedom.
Yeah.
So that's where I have a turnkey property where there's a property manager taking care of all that stuff. I'll have to deal with the big issues, but that's it. Now, those aren't really good lately. One of my favorites right now is lending. I like to lend money to investors where they have to pay me back. It could be shorter term, longer term, depending on the deal. But I usually get paid anywhere from 10, 12+% a year on lending my money to those investors. And just like if somebody gets a mortgage on their own house, right? If you don't pay the bank back, what happens? The bank
Repo.
takes it, right?
Yep.
Repo it, yeah, right. I have that same ability. If I'm on a specific property that I'm lending money to, if they don't pay me back, I repossess it. I can foreclose on them
Yep.
and that property is mine. Ideally, it has a lot of equity so that, just like any bank, right? If you think
Liquidate.
like a bank, you realize you can make crap load more money than you can in Wall Street with high risk, you know?
Absolutely.
And so that's where I can do that kind of stuff. Syndications I mentioned, like you can invest in apartment buildings, self storage units, industrial has been better. Apartments got their teeth kicked in the last 3 years, right?
Yes.
Even self storage hasn't been great, but like definitely like industrial warehouses and things like that have been doing awesome. Parking garages. You can literally invest in parking garages that are near
Mhm.
like event centers where Taylor Swift's going to come to town, and you're going to make a killing off that, right? I mean, there's so many things like that. RV parks, right? I mean, if the right ones. I prefer like Florida type, not like middle of South Dakota type of
Yeah.
RV parks, you know?
Where people want to go, the traffic's going.
Exactly. Yeah. A little higher quality. Another one, some of my favorite ones, oil and gas, even though lately the prices have been down, the cash flow has gone down a little bit. Oil and gas is a great way to still have real estate backing with it, but get paid on the mineral rights, get
Yeah.
paid on any natural gas is pulled out, which is kind of a semi-green energy, oil as well. Get paid on
Mhm.
that. I've got that, and you get some tax advantages on it. I also have a partnership with raw land investing, right? Where I put in a little over $500,000. I'm the financer. They do all the work. They're 30% partner. I'm 70%. But now after that 500,000 or so we've invested is now kicking off almost $13,000 a month,
Nice. I
right?
mean, great. I think the key point here too is, and just for anyone listening, like you don't have to go invest 500,000 into an investment for this. These are where the
Yeah.
place that you, Chris, have built up to. But the point is,
Mhm.
all of these options exist, and to start somewhere, right? The three L's: the lean, liquid, and get out, right?
Yeah.
Uh, but the idea of going to look at these things and cash flow focused, income focused, that being the freedom part. I'd love for you to talk a little bit about like, help define this part here so it's a little bit more tangible of financial freedom, right? I mean, basically,
Mhm.
anyone's really kind of reading in between the lines here. They already got it, but talk about like what does financial freedom mean here?
I see two different definitions. There's financial independence and financial freedom. Financial independence is a number, right? It's math. When my passive investments, my passive income coming in is surpassing my expenses, so I can live from day to day, I'm work optional or have enough money to work because I want to, not because I have to. That's financial independence. But it's not financial freedom to me. Financial
Mm,
freedom is when money is no longer the reason or excuse that you do or do not do anything.
love it.
So when money doesn't no longer dictates my life, because I've seen many people become financially independent and then they act broke
Yeah,
still, because that's a scarcity issue.
yeah.
And so you have to work on the mindset to go along with the stuff. Some people are great at teaching the mindset, but then they can't teach you anything way of how to implement and actually make money, right?
Hmm.
And then there's people that are all implementation based, but they can't teach you how to actually truly be free. You need both. It's like a 1-2 punch, right? You got to have the mindset, the abundance mindset, which is more of a steward mentality, not a spender mentality, not a saver mentality, but a steward mentality. Then you actually can come from a better place of abundance. That's where real freedom comes in.
Love it. So tactically speaking, obviously it's math, it's number, which means
Yeah.
for all you listening, you've got to know what your number is, your expenses, right? And that will get you to that independence level once your investments that you've made are equal to that. So the investments that Chris was talking about, you were talking about here, Chris, is these whatever it is, oil and gas, the syndications, the other real estate and stuff, or someone has been spending a lot of time, as I know many of you are out here in tech looking at digital assets here too. As long as it's cash flow focused and there's the downside is protected, then that helps to
Mhm.
bring up that passive income to that number that makes sense, right?
Yeah,
Um,
great point.
yeah. One of the things I want to, you talked about still holding your insurance license.
Yeah.
One of the things I know that, it's infinite banking.
Mhm.
This is something that everyone may not really know about or understand how it fits into the bigger strategy. Do you mind just spending like a minute or two on what this is? Because I think this is one, be a really good one for those advanced investors to go check out from your stuff too.
For sure. Yeah, it's definitely a very misunderstood concept. I first learned about it in 2006 when I started meeting these real estate investors talking it up, right?
Yeah.
They're saying that's the best thing ever. However, when they infinite banking, if you haven't heard of it, it's basically a strategy, but the product or the tool they use is whole life insurance. Just so you know, TikTok and Instagram has been trying to tell people that index universal life insurance does infinite banking. That's a complete lie. That's a
Mhm.
total lie. It's a sales gimmick. You cannot actually do infinite banking with IULs, believe it or not, at least not very easily because they have fees, increasing costs, no certainty, all that kind of stuff, right? So
Hmm.
it's whole life insurance. Now, understand as a financial advisor, I always taught people whole life insurance was a piece of crap.
Yeah.
It's like, wait, you're not going to make any money in those things. You do the stock market, right?
Yeah.
I didn't know anything about it. That's just what other advisors told me to tell my clients, you know?
Got it.
But here's where they were right. If you buy traditional whole life insurance, it's expensive. And that's what I ended up doing. I bought a traditional policy. And I even asked the guy, I said, hey, is there ways we can pull different levers and make this more cash rich? Because unlike insurance, where it's always death benefit focused, whole life insurance also has this tax free savings account called cash value inside of it. This is
Hmm.
like a high yield tax free savings account. Right now, by the way, it's paying like 6% a year tax free, right? With
Awesome.
no risk, no market risk, none of that stuff. Well, I was like, well, can't we make this more cash rich? Because this is really expensive. He told me no. 2 years later, the recession hit. I was going broke. I couldn't afford to keep paying my premiums. 25 grand went into it. I got nothing back out. I lost it. And I
Mm.
was like, man, that was the biggest waste of money ever. And this is what I found. And this is still true today is that the problem was that the guy lied to me. You can actually pull different levers to make it more cash rich from day one, more so than even the guys that do claim to be infinite bankers and stuff that say, hey, you'll have cash from day one. You can even have more cash from day one than those guys are teaching you, right?
Hmm.
And this is the important point. This is where infinite banking comes in because the whole concept of infinite banking is that money flows in and flows back out. It's constantly in motion, right?
Mhm.
The more motion you've got with your money, the more money you can make, right? It's
Velocity.
it's
Yeah.
velocity of money. You got it. It's not accumulating money and let it be stagnant like most people do with insurance. It's velocity. Well, you can't have velocity if it's all going to insurance costs. And I
Yeah.
guarantee there's somebody here watching this right now that they already talked to somebody about this and they're saying like, I looked at the numbers, but it doesn't make sense because I can make more money outside of this thing.
That's
And the
exactly
answer is
what I hear. Yeah.
yeah, and that's 100% correct. You can. Like from an investor perspective, mine and a business owner perspective, you can make more money outside of it. That's not how I use it. I use it differently. This is why eventually I stopped trusting people. I actually refer to guys that actually I thought would do it like I would want done for my clients, where they would make it cash rich. And then every time the agent would pull a few more levers to pay themselves a little bit more than just doing the best for the client.
Got it.
And so I brought it in house in 2017 because it pissed me off so badly. So I was like, if I can't trust anybody and I can do it myself because I'm an insurance license, I would beat their numbers in like 2 hours. I'm like, I'm not even the expert. I'm beating your numbers. So screw you.
Love it.
But here's the thing is like, but here's how I use it. I still tell people like, say that you've got, say 200,000 that you want to invest out there, right? I'm not going to use that 200,000 to put in the policy to then flow back out to invest because if I do, costs are going to come out, especially in those first few years. But here's what I will have people do is I'll have them use their emergency fund, the money they shouldn't
Mm.
use that to flow through. And the great thing is even the first year, which is the most expensive cost, only about 20% of the money you're putting in comes out for paying insurance costs. That's the worst year. By the third year, it's already paying for itself and making more than what you're putting in. It's like free insurance by that point.
Yeah, because the
So
interest is paying for the premiums.
exactly.
Yeah.
It's paying more than even the insurance
Yeah.
costs inside of it. So say you're paying 20,000 a year into that thing. Well, guess what? By the third year, it's growing by more than 20,000 a year and it just keeps getting better and better because it's high cost up front, lower on the back end, where like term insurance is cheap now, but then it
Right.
gets more expensive later. It's the
Right.
opposite. So yeah, the big thing is this is that, if we can lower the costs, now I have more money in there and I'm just going to use my emergency fund to fund it for the first few years, right? Because I'm not going to invest that money. So instead of don't do this. If someone has 200,000, there will be some guy out there, an infinite banker saying, throw all 200,000 in. Well, let's just say that 25% of that, and that's actually really good, by the way, 25% comes out in cost. You've lost $50,000 that you could have been investing.
Mhm.
So don't do that. Instead, 200,000, invest it. Hopefully you're making 10% a year to create 20,000 a year of passive income. And guess
Yep.
what? If your premium's 20,000 a year, but after a couple of years, you got 20,000 to fund that, you have to do nothing out of pocket, right? You just use your emergency fund to fund it for the first few years, then the cash flow funds it. And here's the key thing. Here's where it's magical, right? And it's better than what they talk about online because they talk about paying yourself interest. Lie. That's a lie. Here's the thing. It is a tax-free savings account. You can withdraw the money whenever you want. You don't have to pay interest. But the reason that we usually pay interest, the other option where we get a collateralized line of credit against it,
Mhm.
you can do it with the insurance company or you can do it with certain banks where they'll give you a line of credit against that cash, but you're not required to make any monthly payments.
Mm.
Why? because they have a low interest that they're charging you, but you're also making interest over here.
Oh, got
And
it.
so say that, for example, you have 100,000 in there. Instead of withdrawing, say, 50,000 for investment, you just got a line of credit from them for $50,000, right? Well, your 100,000 is still in there earning tax-free compounding interest of, let's say, 6% a year, right?
Yes.
That 50,000, you're paying them interest. You're not paying yourself interest. You pay them interest whenever you want to do it. So that 50,000, say, goes into an investment that kicks off, say, say 5,000 a year. Well, take that 5,000 a year, pay towards your line of credit. And what happens, just like when people use their home equity line of credit, same concept, but it's like a home equity line of credit that pays you interest.
Yeah.
And so when you start to pay it down, you start to see the balance go like this. The interest you charge is like this, but the compounding interest you earn does this. So you make a spread on the interest from the insurance company. You make more than what you pay them, and you're still making money in the investment at the same time. And that's what you do. You flow the money out, and that's infinite banking.
I think it's so cool. And I know where, this was a big topic for me to bring up like near the end here, but I just wanted someone to hear about it so they can take that to the next level from a strategy point of view.
Yeah.
So thanks for explaining that quickly, Chris. So I know that we're trying to get through fast. Sorry to put you on the spot right
We just
there,
created a
dude.
whole second podcast just now, right?
I know. I'd be happy to do that in the future as well, but
Tell
I
you what,
knew
if
I
you
had to
guys
bring
want
it
to see
up.
the second podcast on this topic alone,
Yes.
ask us, comment, and then maybe we'll do another one.
Thanks. Anyway, dude, work optional, right? A work optional blueprint. Tell the audience where they can learn more about this crazy stuff, where they can take their game to the next level, where they can learn about, where they can get more of their questions answered if they're thinking about, all right, obviously there's something here. Success leaves clues. So where can they find you, Chris?
Yeah, I mean, obviously anything that's Money Ripples, whether it's moneyripples.com, Money Ripples podcast, you can follow our podcast as well. Social media is the same thing. But yeah, the work optional blueprint is actually available on Amazon. You can actually get the book where I talk about all these concepts, even the infinite banking concept I talk about in there too, as well as all the different like alternative investments and stuff you can do to actually become work optional.
Yeah, love it, dude. Appreciate you, Chris. Thanks, man.
Right.
Those will be in the show notes as well. So go ahead, go there, click on it, go check out Chris's stuff. You gotta know these things, get educated, take ownership, just get it done. All right, guys, thanks so much. We'll see you in the next one. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.